Hey guys, welcome to another Trade Genius podcast. Philip here with Bob Kudla as always. And today we got a good one because Bob has found something that the Treasury's been doing that isn't really very helpful for you or I at home and our portfolios. So let's dive into this one.
Trade Genius.
All right, Bob, so you dug up this interesting chart. What's going on here at the Treasury?
Yeah, so the Treasury and the Fed, so when the Fed makes money doing their normal course of business, where you see that chart there, you see all the blue squigglies that are above that black line, that's kind of break even for the Fed. They give that extra profit back to the Treasury as a form of payment. They keep their VIG, but they give the rest back to the Treasury, and that way when they're monetizing debt, that's why people say, oh, the United States government can be in big trouble. Well, if the Fed's making all this money buying back all the bonds, they give the interest that they're collecting on it back to the Treasury. So it just becomes some sort of Rube Goldberg machine. The only people suffer is us because there's too many dollars in circulation. Well, with this QT, if you notice, the Fed now is drawing money from the Treasury. And you're like, okay, well, what does that mean? Well, actually, what's happening here, because if you tie it into the next chart we're going to show you, is the Treasury has been working as a counterweight to what the Fed has been doing, and they've been slowly bringing down, as you like to put it, their checkbook. This is the amount of cash that's sitting in a checking account under the name U.S. government, and Janet Yellen's been spending it. She's been spending it down, so she's not been borrowing into the bond market, but they've been spending it down. And that way they kind of artificially lower certain bond prices. And this is where Operation Twist can come in, all those games that they can play. But the bottom line here with this is that you have a situation where the Fed will continue to raise rates. They'll continue to reduce liquidity, right, which squeezes Main Street. But at the same time, it's creating some sort of perverse QE effect that is keeping and suspending the prices of assets higher for Wall Street. And it's counterintuitive, but they figured another way to screw Main Street or to allow us to pay for Wall Street. So they could keep doing this for a while, Phil. They can just keep raising interest rates that the banks then, trying to get to that positive, yield that they're trying to do. Mm-hmm. At the same time, we're paying for it out of the Treasury until the Treasury runs out of cash, and then the whole thing implodes. So it's a really fascinating and weird situation, but it's creating an environment where, heads they win, tails you lose situation.
So if the Treasury balance obviously gets a little too low, they're just going to issue more T-bills, right?
Yeah, they're going to have to go to the bond market. And then you notice we've been having this kind of a little bit of a good guy here with, the 10-year rates have been falling a little bit, trying to get that thing back to flat. But if they go back out into the markets again, depending on what maturity they're buying, they can create another situation where they turn the bond market upside down again. And I think with stocks so fragile at this point, I think then that could drive the second wave down. And look, they're going to run out sooner than later here. They're getting fairly low. They basically been killing the seed corn everywhere you look, right? They drew down SPR. They're drawing down our defense munitions to Ukraine. They're drawing down the Treasury cash. And so we're going to be in a situation where we're going to be very vulnerable going into 2023.
Do you think that we're going to see a bump here in the balance of the Treasury going forward, or do you think it's further drawdown?
No, I think it'll draw down first, but what's going to happen, Phil, and we're seeing it this week, right? Monday, Tuesday has been drawdowns because people are starting to get worried here about the ability of the Fed and the Treasury here to maintain economic activity. So I think we hit the bottom on the dollar, and I think we hit the bottom on probably today, maybe the short-term bottom on the 10-year, and look how fast that affected the stock market.
Right.
So so I think this is really important levels, if you will, for both the bonds and the dollar. The dollar rises from here. The Treasury keeps drawing down. They try to keep it from running away on them. At some point, they're going to have to go into the bond market and buy bonds, which then should raise the price of the 10-year higher again. And then what's going to affect is going to be the stock market.
Yeah, and that would undo the yield curve inversion, right? The 10-year going back up, and which is what we tend to see when the final leg of the bear markets play out in a typical secular bear market. The yield curve cranks back up. So I guess that would be a probable outcome.
Yeah, and look, I don't think people realize over 20% of the S&P 500 is cash flow negative.
That's bad.
They rely on the credit markets
Right.
in order to maintain a viable company. And it was okay when they're borrowing at 1%, but now anybody's going into the markets now are, they're paying well at excess of 5%. Probably now paying premiums because their balance sheets are so poor. And I think it's an issue that has not yet really hit the markets, and that's probably going to be playing out over the next 2 years. Or what else you're going to see are companies that are actually cash flow positive trying to pay down their debt by issuing more shares, which then also crushes the stock market. So it's going to be one of those situations where cash flows are going to start falling because we're going to go into recession. You're going to have dilution because they have to get their debt to equity under control. And those who can't are going to have to then basically wind down operations, which also affect the stock market. So I don't see any really good scenarios in here for the stock market going into 2023. I mean, we're going to have our bumps and rips and stuff like that, but I think the long goodbye is going to come from this, and I think the Treasury is running out of room to manipulate the markets from implosion.
Yeah. Well, it kind of falls in line with our outlook we've been sharing in the last few videos. Is we're headed for lower most likely in 2023, but coming out of that, there's going to be some generational buy opportunities, we feel. So stay tuned as things develop on this. But yeah, thanks for showing us the inner workings there. And this is the kind of stuff that happens behind the scenes that most people don't realize. And I think the more people that have eyes on this, the more honest we can keep things. But there's a lot of work to be done in that regard yet. So anyway, thanks for sharing that with us. And thanks for being with us today, everyone. Please hit like and subscribe. Really helps us out. And we'll see you on tomorrow's video. Thanks a lot.
Trade Genius.